Hey everyone, this is Nick with Us versus Herd. Today I'm going over how to make money trading options, or how to use options to make money. The thing about options, unlike stocks, there's a lot of ways to make money. You can buy options, you can sell options, you can sell options, you can do debit spreads, you can do credit spreads, and really the list goes on. Most people really think that you can just buy calls and sell puts, or buy puts and sell, vice versa. You get the idea. It gets confusing, but there's a lot of different ways you can make money. I primarily trade options here, long term and both short term. So there's a lot of ways. I'll take you to the options chain here. This is what you call an options chain here. Look here, we're looking at Apple, and as you can see, there's a lot of different dates here. And the different dates, this, I'm not going to go into big detail for it because this is not really a beginner options video. This is just kind of give you a brief explanation of all the ways you can make money trading options. Some people aren't sure. They think they can just buy and sell puts and calls. So for those that don't know, this is the option chain. As you can see here, there's the dates, and unlike stock, options do expire. And this is how many days to expiration. So January 20th, we got January 20. This is January 2020, by the way. We got 708 days. So you can buy short-term options, you can buy long-term options. It's really up to your trading plan and how aggressive you want to be. I kind of mixed it up. As you can see, I have a position here on Apple 71 days out, so that's more of a longer-term position. But I also mix up the short-term strategies. So most of you, we can just go here. Let's go into March. Kind of give you a better idea. The market's been all over the place, so that's why premium's kind of fat today. Apple's down almost 3% today. And right here you can see you have the bid and the ask. This is the call side, this is the put side. So for those that don't know, calls mean you want the stock to go up, puts mean you want the stock to go down. However, there's a lot of different ways. So the first way that you need to get used to is just buying and selling calls and puts, and that's just buying one of these. Costs you $4.15, and if you don't know, you multiply that by 100, because one contract equals 100 shares. So this could cost you $415. So if you click on confirm, it's going to tell you, see, $415. Your max loss is $415. Your max profit here is infinite. So there's no limit on the amount of money that you can make. The maximum that you could lose is the amount that you pay, which is $415, the price of the option. So there's a lot of things that work against your options and a lot of things that work for it. One thing is time. If your option is out of the money, meaning that the price is above or below your strike price here. So if you have a call and the stock price is at, let's say we have a call here at 155 and the stock is actually at 100, it means you're out of the money. So theta will start eating at your option, and this will start to decrease in value over time. The longer it's out of the money, the more that it will decrease out of time, meaning the less likely that's going to hit your strike price. So that's what most people know how to trade options, buying and selling calls and puts. Now there's a lot of more sophisticated options so that you could use theta to your advantage. So you could use time to advantage. The wearing down of the option is selling a credit spread. So if you wanted to short Apple, instead of buying a call, you would instead of buying a put, you would short a call. You would short a call or a credit spread. So if you wanted to short a call, you can just hit sell here, and you would be short one call. Now, shorting naked, this is called selling a naked option, which is kind of risky. I don't really like this because your max profit is only $3.95, which is the price we pay, and the max loss is infinite. So it's kind of like shorting stock. Especially those that are shorting penny stocks, like your losses are unlimited. So if you're short the, let's see here, the 160 strike and it goes to 180, you're going to be in big trouble. You're going to be owing, $2,000 or more on this strike. So that kind of leads into the other option. If you wanted to short Apple, you wanted to have a defined risk trade, you can sell a credit spread. And you go into here, you can go to sell, and you can go to a vertical. This is what you call a credit spread. And as you can see, your credit's a lot less than selling naked. Naked, we were making $3.95 here. Let's go up to the 160 strike here, just to keep it consistent. So instead of making the 395, this credit spread, we're only making 158. Now you can widen the spread, however, you take on more risk. So if you take a look at this trade here, our max profit's only 158, but our max loss is 342, which is a lot better. It's kind of like a 2-for-1 scenario here. It's unlikely you'll get the full max profit. Better targets are hitting 50%. But just so you see here, this is one way that you can use it, and people, like to buy at the money, in the money, or some people that are trading more short term will buy like out the money, where the probability here, I have this column here with the probability of in the money. This shows how probable it'll be in the money at the time of expiration. So at 180, it's only 5%. So that's, the further you're out, the less likely that it'll go in the money. That's why these are less money. So you'll be getting less credit. So if we sold this one, this one was like 158. So if we sold one here at 170, we're only getting $65 for it. Max profit, we're only getting 65 cents. So that's why, because it's less likely to happen. So the closer you are, the more risk you take on, but the bigger the payout. So depending on how you trade, you kind of go that way. Now, the same thing works. I just give you an example of call. The same thing works for the put sides. You can sell verticals on the put side too, or you can sell naked calls or puts, or sell puts as well. So here, the other option is to sell an iron condor. And selling an iron condor means that you want it to be neutral. So let's say you think that the Apple stock is going to stay here at 155. It may go up, it may go down, but by the time your expiration hits, you think it's going to be about the same. So you can sell an iron condor, which means you can make money on both sides, and all that is having a credit spread on both the call side and the put side, and it has to end up in the middle. So we can select iron condor here, and then you can widen this, and stock price is 155 right now, so you might want to tighten this up. So instead of 160, you might want to make this like 140, 145. And you can leave it here. So take a look at this trade here. So basically we want it to be below 170 and it'd be above 140. So we're currently at 155, so it can fluctuate in between there, and as long as it's out of not hitting these strikes here, you're going to be taking in the credit. Here we're going to get a $1.61 credit for this trade, as long as Apple doesn't move too much, and our max profit's 161, the max loss is 339. So that's how you can make money having the stock price stay the same, because sometimes stocks go sideways. Sometimes there's huge dips and huge rips, but a lot of times stocks just move sideways for like maybe a month in consolidation. That's a good way how you can sell a credit spread for the stock staying neutral. And if you kind of go through this, I'm not going to go through them all because a lot of them require a lot more buying power than what most people have. You can do a strangle. That's pretty much selling at the money here, a call and then a put. So if you think the stock's going to move a lot, you can have it sway. There's some stuff in here that's not here. We can actually open up. Tastyworks has some more for you guys. So yeah, they have the Jade Lizard. You can get calendars, but that's basically the gist of a lot of those different ways. Now you can get real fancy with it, like you can buy, let's say you did let's say you bought one option down here. Let's say you thought Apple was going to go down, but you wanted to protect yourself in case it went up. You can buy you can do a vertical spread. I don't know if they're going to let me do it here. You can do a vertical spread, but instead of buying one option here at the 150 strikes, you're going to buy one, you can actually buy two and still short the one. So if it goes down past a strike, you're going to be making more money. If it goes up, you'll be covered by the put spread. So, there's a lot of different ways. We'll go over things in more details. I just wanted to give a brief overview of kind of all the ways you could make money. Obviously, you can get fancier with those techniques and more advanced as you start learning. But those are the very basics that people typically use. They buy and sell calls, vertical credit spreads, and iron condors. Those are probably the most popular that people use to make money in the market right now. So if you have any questions, definitely leave a comment below. If this is the first time coming across the channel, definitely subscribe. We have a lot of content coming out pretty much daily. Like and leave a comment below.